Hey folks, it's Dave Burrows. I want to welcome everybody to this week's Barometer weekly webcast. It's good to be here. It was a quiet week last week with the Canadian market closed early in the week, and of course the July 4th weekend late in the week. And it's always an interesting week because with markets thin and lots of participants not there, all kinds of shenanigans go on. But everybody, I would assume, is back to work, and we're here in July. July historically actually a pretty good month, certainly the first half. And so we'll talk a little bit about kind of what we're seeing going on market wise. Everybody's watching the newspapers and the press and the digital media to see what's going on with tariffs. We're about a week away from getting launched into the earnings period for the second quarter. We're halfway through the year, and lots of big themes to talk about. So why don't we jump right in? We continue to believe we're in a structural bull market in stocks. Started in the US in 2013. And this bull market just continues to march along. Most recent cyclical bear market ran from the end of 2021 through 22, end of 2020 through 22. But here we are basically at new highs. Market has acted like it does in a structural bull market. It's held a series of higher lows, continued to make higher highs. And this bull market, a lot like the one in the 80s and 90s, is being driven by, demographics and changes in the world. The 80s and 90s were the baby boomers in their sort of peak accumulation phase. And we're in the phase where the millennials are in their peak phase, which is likely to go on a long time. So, as much as we all worry about the things that can bring an abrupt end to a good bull market, and we do see cyclical downturns, there should be a tailwind over the next number of years, and we aren't seeing any change to that. If we look at the S&P, the pullback coming into April on the tariff news came right down to the trend that's been in place since the 2022 low. We've had quite a furious rally off that low, despite lots of questions out there as to whether tariffs might impact the consumer, might impact availability of product, and impact inflation. But you can see the S&P has now made a new high. Now, I've had lots of folks say, well, it could be a double top. But if you go back and look at the history, there are no double tops that took place after the market made a new high. That's a pretty important signal. Seasonally, as I mentioned, if we look at 2-week periods, the first half of July is actually the strongest 2 weeks of the year. Very often folks come back from July 4th. It's often sloppy in the second half of June, which this year it wasn't. But people come back feeling pretty good. And not a lot of folks coming to look at their portfolio and say, what should I sell? If we look internally in the market, percent of stocks trading above the 50-day moving average, roughly 80% of stocks in the US are trading above their 50-day or intermediate trend. That's positive. It means lots of stocks are performing well. If we look at the advanced decline line, or percent of stocks advancing as opposed to those declining, we're making a new high. So in simple terms, we like to see improving breadth. Now, the rally that we've seen off the lows really was quite extraordinary. Off the April 8th low, market has rallied 26% in US dollar terms. Now, when you look at it in other currencies, it's not the same. S&P actually still slightly negative on the year, for instance, in Canadian dollars. But it's been a great rally. Now, when I look at these dates, I am always interested to see where we were in the scheme of things. March of 2009, well, that was the very end of the tech wreck. March 23rd of 2020, well, that was the worst point in the COVID sell-off. August of 1982 was just at the beginning of the long bull market through the 1980s. August of 1998, well, that was the end of the Asian currency crisis. December 24th, this is a date I'll remember because this one hurt us. Market reversed on the 26th and rallied 20.6% over the course of the next 65 days. That was the end of the Fed's taper tantrum. December 4th, 1987. Well, I remember that too because I was 1 year in the investment business. We'd gone through the crash in October and the market found a low on the 4th and didn't look back. October of 2002, that was the worst point in the tech wreck. There were some stocks that took it to a lower low in March of that following year, but the majority of stocks bottomed in October of that year. So when we look at it and you take those dates and you go forward after these giant surges off lows, 6 months out, things look pretty good. 1 year out, 100% of the cases higher, an average of 22% over the next 52 weeks. Now that's versus all periods up 11. 2 years up 33.6% versus an average of 25, and 3 years out, again, most of them pretty darn positive, up an average of 39%. So I know there's lots of things to worry about, and we don't make decisions based on this. We make decisions on what's going on in the real world. But I think it's important to study history because emotions can really get the better of you. And generally, when you get a big move like we've seen, while there might be some news on the surface that's scary, there may be some really good things underneath the surface that are causing money to move into stocks. So if we look at the NASDAQ, it pulled down 25% off the highs. But here we are back above the highs. That's important. The equal weight S&P has not gone back to highs at this point, but we did have 3 lower highs, and now we're above the first, and we're above the second. So things are getting better. So it tells us that the very biggest stocks have had the best bounce, and arguably and understandably, the general public who have been looking to put money to work after that sell-off in April went right back to the big names that they know over the last few years that have done well. And we'll see whether the broader market follows it along. If we look at the Russell 2000, these are mid-sized companies. Again, not quite as favorable, but you got to start somewhere. You got to the leading stocks lead. Looking outside the US, very favorable. This is the S&P Developed World ex-US ETF. So an ETF of the 900 odd companies outside the US that make up the global index. And this is important because just like the US market breaking out to new highs in 2013, the global markets have broken out to new highs in 2025. Now we watch with interest because historically when global stocks start to outperform and attract capital, money goes from somewhere. Now maybe that it's going from the bond market because bonds aren't behaving very well. Or maybe it is that some money is being drawn back into local markets because currencies are stronger and markets are stronger. But the Euro Stoxx 50, it's just started a new bull market, and there will be years to go as we've come out of this long period of bear market. German market, the Italian market, the Spanish market, the Swiss market, the UK market all look the same. Southeast Asia got going a little earlier, Latin America a little later, Peru, Mexico, Argentina, Chile, and probably one of the most important ones, the Japanese stock market. Now, back in 1986, there was a view that the Japanese were going to take over every major company. They bought Pebble Beach because they were all making so much money. And of course, that's when the tide starts to go out, when everyone's decided this is the place to invest, and the Japanese market did poorly for 33 years. Well, we're just starting to break out to new highs, and this is in local currency, and the local currency is appreciating. So if we look at it actually in US dollar terms, the chart looks better than this, and we've looked at that in some of these webcasts. Even emerging markets, after a long period of relative underperformance, this blue line is relative to the S&P. has relatively started to appreciate and improve since December, outperforming. All these markets are outperforming the US stock market over the course of the year, and so is Canada. So there are some commonalities among these global markets. They all tend to have a lot of financial services, which we know have been doing well. There's a lot of global industrial companies that also are doing well, and strangely doing well right now, despite the fact that we keep worrying and waiting for tariffs. A lot of global markets have energy and materials, certainly Latin America and the UK. And valuations are less expensive. Now, when we look at the current valuations, global stocks, including US, are at 20 times earnings. US stocks at 22.9 times this upcoming year. Europe at 14 times, UK at 12, Eurozone, so on. You can see global stocks are traded at a discount. When we factor in earnings growth expectations, it's not as big a differential because US stocks led by tech are growing a little faster. But on the other hand, European and Latin American companies are a lot more cyclical or more economically sensitive. And so their earnings can be revised higher. We'll have to see what happens. But I do think it's relevant that the TSX is outperforming the equally weighted S&P really for the first time since 2009 at the beginning of this period. And that's a change. On fixed income, we had the low in yields in 2020, like we did in 1950. After 1950, yields went higher in fits and starts over each business cycle until 1981, 30 years later. So the question is, how sustainable would this move in rising rates be? Well, when we look at the 30-year Treasury yields, they bottomed in 20. They're not really showing any sign of slowing down. In fact, monthly, they're just slowly marching higher. We're pushing up against 5% today on a 30-year yield. And some of the technical factors are starting to point to higher yields. It's not just happening in the US, it's happening in government bonds around the world. Japan, importantly, one of the biggest bond markets, is now through 3%. And going back to 2018, was at 0.09 of 1%. So, the bond market, the bear market in bonds continues, lower lows and lower highs. This is the long-term US Treasury bond ETF. And in the past week, we've broken this little area of support. So there's really not very much that I can say that's bullish. The bond market either is sensing improving growth globally, that's possible. And so risk dollars are going towards equities. Or the world is expecting a continuation of inflationary conditions or deficit spending by governments, and that's not impossible to think about when you look at what happened with the big, beautiful bill in the US. Now, some would say that tariffs are going to offset the increase in the deficit. We'll see, because I think that's a moving target. But bonds, not so attractive. Now, commodities continue to improve. So if we think about it, you buy bonds when you think there is risk of disinflation or deflation. You get fixed income in a world where maybe rates are going lower. Don't confuse short-term rates with long-term rates because they're different. Short-term rates set by central banks, long-term rates set by the market. Commodities, on the other hand, people buy when they think there could be inflation or they want to own hard assets that are scarce and can't be printed. And I think the message right now is fairly clear. Since the lows in interest rates in 2020, commodities have been a strong outperformer. We've talked a lot about gold, and so far gold is having a very nice first leg of a bull market, a lot like the first leg of the bull market back after 2002 when gold got going, and it got going for a decade. We'll see. It's been sort of going sideways for the last 4 months, looking at it under a microscope nearer term. We made a high in April, and we're clearly in higher highs and higher lows, but we're consolidating, and that's fair. Things got pretty overbought when we look at some of the technical indicators. Seasonally, I think we want to keep in mind that July and August over the last 15 years have been pretty positive for gold, with some very strong returns after seasonally weak May and June. So over 15 years, there's been some weak Mays and June, and this year, wasn't so weak, but it was negative. We'll see whether the seasonality continues. But silver has started to perform quite well. Both silver and gold down a little today, but that started a nice uptrend. We've talked about uranium. We've talked about some other commodities performing well. And this is a chart I've been putting up pretty regularly over the last few months. And this caption has been here, watching with interest, because we wanted to see if it could break out to new highs. Well, today, copper was up 12%. And, lots of things drive price. Today, Trump insinuated that he may consider putting a 50% tariff on copper coming in from outside the US. That certainly lit a fire. This happened while I was sitting in a meeting. It was a bit of a surprise. But we added copper positions over the last month because we were getting pretty darn close to breaking out. But when you again come out of a long period of bear market, this is 15 years. That's unlikely to be a blip. It's likely to be something that lasts longer. And this is what happened in the last bull market in copper. It went up 535% between 2002 and 2008 over 6 years. So commodities relative to bonds are clearly outperforming and are clearly telling us that the thing we need to hedge against is the risk of inflation. Gold versus the aggregate bond index since rates bottomed in 2020, pretty clear. Gold has been the hedge for portfolios. Even in the drawdowns in the stock market, gold didn't go down. So this is something that we're watching. S&P versus bonds also outperforming. In fact, this month they're making new highs relative to the bond market. So we try to lean toward the things that have a tailwind. We don't need to be anywhere. We can pick our spots. There are some portfolios that we need to have some bonds in, balanced accounts where that's the mandate. But we really are sort of at a minimum. And interestingly, commodities relative to stocks are certainly holding their own. And over the last number of months, look as though they've made a shift. We'll see. So if I do relative strength of asset classes, the strongest group currently is commodities. And within commodities, precious metals, energy, and agriculture. We're seeing now improvement in industrial metals. International equities come next. Global stocks are outperforming. Europe, emerging and developed, you can see. Domestic equities, cap weighted, meaning large caps are outperforming equal weight. And then when we go down, cash currencies, developed market currencies over US dollars. And in fixed income, interesting, high yield and international bonds are outperforming US corporate bonds, US sovereign bonds. So then there's currency. US dollar is weakening and has been weakening since the beginning of the year. That's important. If we look at US dollar versus all of the major global currencies, it's about the worst over the course of the year. US dollar down 7.5%. It's one of the reasons why we have hedged all of our holdings that are outside of the US back to Canadian dollars, so that if the US dollar weakens or US dollar holdings weaken, we hedge the currencies in our pools and funds. We can't do it in our separately managed accounts, but in the pools and funds we can. So whether we're looking at euro versus US dollar, making a turn higher, or British pound or Japanese yen, or frankly, Canadian dollars, all of the major currencies are improving. So that's an interesting thing, because if global currencies are appreciating and global stock markets are outperforming and global government bonds are outperforming US Treasury bonds, it's not hard to see how global investors might consider repatriating some assets back to their currencies, back to their stock market, back to their bond market. And that could perpetuate, some weakness in US Treasury bonds and US currencies. And valuation gap, is certainly there. So look, we have to pick our spots. Our job is to find leadership. Where's the money getting put to work? That's why I do these charts every week and review them, because we want to make sure we're focused in the right neighborhoods. We're always watching for change, new leadership to emerge and old leadership to recede, so we can transition our holdings. In the absence of leadership, have a willingness to sit on cash. Although, cash value depreciates with inflation. So we don't tend to sit on cash for a long time, but we wait and see new leadership emerge. 80% of return comes from being in the right neighborhoods, getting the asset class right. So we think right now commodities and equities. Geographically, we like Canada, we like global stocks. Sector-wise, we'll talk about that. And then we try to find securities to populate the portfolios with that are good getting better. So the neighborhoods we're focusing on are sectors or themes where we can see breadth expanding, where the percent of stocks performing well is improving, where more and more securities over time are participating in a rally. That's healthy. The bottom up work we're doing is aimed at finding stocks that are really solid to begin with, but where we can see something changing for the better, like an acceleration in earnings or an improvement in the cash flow, accelerating dividend growth, and price that would agree with that, where technically things are behaving favorably, where we can find things that are good getting better, and they line up in parts of the market we care about. Well, that's where our portfolio should live. And then we have to constantly cull, because from time to time sectors run out of gas and breadth starts to deteriorate. And when that happens, it may not be the leading stocks to get hurt first, but we want to know when under the surface the weaklings are peeling away, because it tells us to be a little more cautious. It tells us to raise a bit of cash and tighten up our stops and stop putting new money to work. So as we go into July, which is seasonally a pretty strong period, the breadth data that we're tracking is pretty positive. Percent of stocks in uptrends in Canada, was down around 40, now about 53%. So more stocks performing well. Bullish percent in the US has been rising, it's in green, but we're still below 50% for all stocks. In the NYSE, it's closer to 60% of stocks in uptrends. NYSE has a little bit better breadth than, say, the Russell 2000. And globally, we've now moved up through 50%. Now, what can we expect? In a good bull market, you can get to a point where 70 or 80% of stocks are participating in the rally. We're a long way from that right now. When things get overcooked and everybody is positioned, when everything is going up and it feels great, that's when you should get concerned. And that's when we watch for deterioration. But at this point, things are not too bad. Percent of stocks trading above the 50-day moving average, improving nicely. Actually, as I mentioned earlier, 80% of stocks in the NYSE are trading above their 50-day moving average. Globally, we're seeing the same thing. Percent of stocks with positive weekly momentum had a little period of weakness in June. They've started to improve again. Percent of stocks making new highs versus new lows, certainly getting better. Percent of stocks trading above the 200-day moving average, continuing to improve. So the backdrop for equities globally is pretty good. It's great when the US market's doing well, but when all major markets are participating, it's even more healthy, because it means that investors from around the world are moving money into equities. Now let's talk about sectors. For the last 2.5 years, we've talked about how financials have exited a bear market they were in from the financial crisis and are now marching higher. Risk reward here, I think, is very good. When rates are rising on long-term bonds and short-term rates are lower, there's a spread that financial services companies can make when they're lending money, right? Power is in the hands of the lender. And capital markets performing well, capital markets banks doing well. This is US financials, and this is the US broker-dealer universe within the financials. Relative strength for broker-dealers, capital markets banks made a new relative high yesterday. So this is a group led by Goldman Sachs, Morgan Stanley, Schwab, so on. So Morgan Stanley would be our biggest weight in this group, just made new highs. Of course, we have a larger weight in JP Morgan, which also fits into the capital markets group. And as I think most people know, we added significant exposure to European financials. This is Banco Santander, which was an ad we made a couple of months ago, made a new relative strength high today, better than 95% of companies in the S&P, and really, shining. We mentioned a few weeks ago, Santander trading at 9 times earnings versus Goldman or Morgan Stanley and JP Morgan at 15, 16 times, with excellent growth to go along with it. And earnings have been getting revised higher. Eurozone financials are only 5 months having exited a bear market. So again, early days here. These are positions I think potentially we could hold for a very long time. Fairfax Financial, we've had for the last couple of years. It's been a champ. It's our largest position. Didn't start that way. It's grown into that. Even with property and casualty insurance companies going through a correction over the last few weeks, Fairfax has continued to charge along. So this has outperformed Berkshire Hathaway since the 1980s, and is a beneficiary of strong capital markets. Our investment portfolio, if it generates a return in excess of the claims they're paying, that's where the profitability comes from. Industrials continuing to act well all year long. We've seen relative strength rising. Of course, group got hurt in the sell-off in spring, but relative strength held up. And within this group, lots of stocks doing well. 55% of stocks are making 20-day new highs. The index, of course, has made a new high. We look at aerospace. We've talked a lot about that. Relative strength continues to improve. The defense stocks performing well. Embraer, one of our newest ads, over the last couple of months, made new highs this week. MDA, which is another new ad. This is a stock that Amit brought to the table. Aerospace, we know it for the Canadarm, for the space programs, but they're in the satellite business. And the success of Starlink has raised opportunities for other companies providing cellular communication through satellites. And MDA has a 5-year backlog. We paid, I think, around $29. It's $38. It's really blasted off nicely technically. Anything to do with improving the power grid, also performing well. These are companies, manufacturing companies, industrial companies, selling goods into the power grid, and GE Vernova making gas turbines, and now nuclear turbines, doing really well also. So industrials continue to lead. Now in energy, we've said it's a mixed bag. Relative strength for the overall group has been weak. If you look at the largest producers, this is the equally weighted basket of Canadian producers, it's acted better. We're waiting to see it break out to make new highs, to add positions. Some of the gas companies have been a little bit frustrating. It's the time of year. Imperial Oil, though, really is about the best performing large cap there is. And this is a large position for us. Great dividend growth, great cash flow growth, nice relative strength growth. And again, we think we're in the early days of a bull market, looking back to the bull market through the 80s and 90s, but the early 2000s, pretty darn strong. The liquefied natural gas theme continues to chug along. 2 of the tankers leaving Canada's newest liquefied natural gas facility are the first 2 to leave. And so some of the companies like ARC and Tourmaline are likely to benefit. We did scale our ARC position back just because, there's other things to do, and it's been languishing. Uranium in energy is a different story. It's just getting going. Cameco over the last year and a half has really outperformed, but again, we look back to the last commodities bull market, it was up 2,200%. So this could be early days here, and it's clearly a leader. In materials, the gold stocks, as I mentioned, have been consolidating for about 8 weeks above the moving averages. Nothing to be worried about here, I don't think. Agnico just sort of has moved sideways in the scheme of things, again, early days bull market here. Wheat and precious metals also paying us a dividend, but has consolidated maybe from an overbought position. Kinross is about the same, although Kinross made a new 52-week high yesterday. They're all a little weaker today. On the copper side, the copper miners ETF showing strength before the copper itself broke out. We added Hudbay Mining. This is a company that has multiple mines in Canada and in the US and Peru. We think if I look at a very long-term chart, again, this is a stock that's just breaking out. 200-week moving average is just turning higher. It's trading above all moving averages and trading at a new monthly high. I think some of the mid-sized copper producers could do quite well. Moving on, communications. The communications sector, and here we're really talking about companies like Meta and Alphabet and Netflix. Relative strength has been in line with market. It has made a new high, pulled back a little bit off making that new high. Meta and Netflix continue to perform well. And tech has had a very good resurgence. After being down 25% in April, now trading better than 80% of the companies in the S&P. And of course, the leadership here has been cash generating companies, not early stage companies. So this fits with our dividend growth theme. Rising stream of dividends for a rising cost of living. There's a bunch of these companies that generate really excellent cash flow and have nice dividend growth. And this is an ETF that holds a basket of tech dividend growth stocks. It's actually outperformed the XLK, which is just pure growth. And of course, we're anxiously, waiting for the next NVIDIA earnings after coming out of the stock last year. We re-entered this spring because relative strength versus the market really started to improve. It's the leading stock. I think if you're worried about the market, this is a stock you watch because it's very broadly owned by professionals and folks that don't know a whole lot about the stock market. But this is holding right up here at the highs. The fact that we've made a new high after consolidating for 18 months, I think is pretty constructive. Other semis, and this is a highly economically sensitive group, are behaving well also. We also own Broadcom. We own Lam Research. So 3 companies in the semiconductor sector, and relative strength really has come charging back nicely. So there's some really strong parts of the market. There's some stuff I think we can avoid. Consumer discretionary. If we think that tariffs could have an impact and things might slow down, if we think that the employment picture is not quite as rosy, this is a place we might want to be cautious. And the market's telling us that. Relative strength has been weakening now since November of last year, has not come close to making a new high. Consumer staples, a very similar picture. Although this is a more defensive sector, a sector you'd expect to do well if people think there's problems out there. Relative strength here is just caved. Not a lot to do here. Utilities, another defensive sector, weak relative strength. And healthcare, just horrible. Whether you're looking at healthcare providers or pharma or medical devices. This is the largest industry in the US, really performing poorly. So this is a market of haves and have-nots. REITs. If you think about it, all of these sectors are highly impacted by high long-term interest rates. Real estate, it's a leveraged asset. Utilities borrow money to build big plants, highly capital intensive. Consumer, negatively impacted by higher financing costs and higher tariffs. I would say that the offensive sectors, highly cyclical sectors, and companies that can put their prices up are outperforming as a group. And the groups that are very rate sensitive are having a harder time. Same in Canada. Telecom, relative strength weakening, utilities, real estate, healthcare, no change. So the message is focus on hedging your portfolios with assets that perform better in an inflation environment. This is a chart of the gold versus the utility sector, an inflation asset versus disinflation. This is S&P cyclical stocks relative to defensive stocks, a new high. This is gold. This is high economic sensitivity companies versus defensive low volatility stocks, high beta making new highs on a relative basis. So these are important themes. The other thing that I really think is important is that the crowd is going the other way. ETF inflows year to date, the biggest one, Treasury bills, intermediate duration bonds. Okay, precious metals are certainly getting some flows. Short duration bonds. Things that are not getting flows in. Cyclical sectors. The cyclical sectors are the best performing part of the market. Small cap equities. Well, we'll see. But I think it's interesting that there has been no major step into cyclicals. They are generally underowned, and lots of people looking for safety, and they're not getting it, right? Aggregate bond index is not generating, any kind of return. The Canadian bond index, really no return. If I look at the breadth picture by sector, the strongest groups on the far right side, they're economically sensitive groups. And the ones with small percent of stocks performing well are largely, more defensive. So we're coming into earnings, and this is going to be an important couple of weeks when we look at the different groups globally. Expectations for 2026 over 25. Materials are looking for a nice lift over the next year. Expectation is that industrials have a better year next year versus this year. Discretionary is just generally being revised lower. Staples generally revised lower. Healthcare generally revised lower. Telecom, which I believe would include the communication stocks, revised lower. So we'll see. We'll see this is revised higher. Finally, from an exposure standpoint, we have to put our money where our mouth is. Financials continue to be our biggest weight. We think the risk reward is great here. Dividend growth is strong. Industrials is a sector that continues to grow. Energy is about 12%. That's actually come down a little because we reduced some gas exposure and some exposure to the pipelines. Materials has continued to grow. It's 8%, most recently adding copper. Tech is growing, but we think, we could continue to look at this group, but risk reward valuations are higher. We'll see. Communications has been pretty steady. And then the defensive sectors really are not very represented currently, and cash, is fairly low heading into a stronger seasonal period. We're in a liquidity cycle, right? Central banks around the world are cutting rates. Fiscal stimulus clearly is going to continue with big, beautiful bill. If we look at warnings from high yield bond yields, the excess return bond investors are demanding to buy either high yield bonds or investment grade bonds is going down. It means that people aren't concerned about credit risk. If we look at volatility, after a little spike in April, right back down into the range we tend to stay in during a cyclical bull market. So despite the news, market's telling us a different story. And this can go on a long time. So last stat, when the market came into the third quarter with a head of steam and with strong breadth, historically, the third quarter winds up being pretty good. When you come in with some weakness, tends to be that you get that seasonal third quarter weakness. So versus all observations, this is the situation that we're looking at. We'll watch for change. We'll watch to see if there's anything that we need to do differently than we're doing now. But I think importantly, the addition of some of our commodity positions, the addition of our global positions, avoiding fixed income is working, and being targeted means that we're not lugging some of the sectors that are really on a relative basis underperforming. We're feeling pretty good about things. So things get more difficult, we'll get defensive. That's our tendency, and we'll keep on doing this weekly. I got a few questions here, so let's see what we got. Anonymous attendee, can you please share your view on Alamos Gold from a technical and fundamental standpoint? So Alamos Gold is a mid-tier gold producer. They have multiple mines. We think it looks quite good. They had some lower grade ore that impacted their last quarter. But like many of the other gold stocks that's been consolidating over the last 6 weeks, technically, I think it looks fine. I'd be a buyer of the stock. I own it personally. So I guess fundamentally, I think it's good. And technically, I think it's fine. Deborah's asking, many peeps put money in GICs. We're paying 5% and they're coming to term. Where do you think this money is going to flow now, given the low return on GICs? I think we are in the very early stages of money leaving fixed income and leaving things like term deposits to try to focus on companies that are growing their dividend. We know that companies with high dividends but low dividend growth continue to underperform because they act like bonds. It's almost like fixed income. But we know that from 1950 through 1970, the last time we had a long period of rising rates, over time, more and more money flowed into dividend growth stocks, and we see that technically in the market, but we think it's very early days. So I don't know that everybody is going to get there at the same time. That's not the way the market works. One by one, folks will decide that that's a pretty good idea. And there's lots of opportunities, not all of them obvious. You know, Imperial Oil is a dividend growth stock. CNQ is a dividend growth stock. A lot of the banks are dividend growth stocks. JP Morgan, you know, has an unparalleled record of raising their dividend. So we think that looks pretty good. Bob is asking, how do interest rates affect margin strategies of big money? Long only large investment managers don't tend to use margin. Hedge funds do use margin, and obviously a higher cost of money makes it harder for them to make money. I worry about leveraged credit strategies where there isn't a great tailwind for credit. But it probably impacts it around the margin, but I don't think it's, you know, it's not like rates have gone from, you know, 1 to 10. They've been working their way up slowly. Brian, do you know of any models that have accurately predicted how a given level of political instability will affect the markets? That's a great question. You know, in the end, I always say it, the market is a giant machine. There's 1,000 moving parts. Politics are part of it. Like them or hate them, the current president is doing things that will be positive for some industries and negative for others. And our job is to assess whether people believe him or not, believe it or not. We can see that industrial companies have clear market leadership. And that's not just defense stocks, it's industrial machinery companies. If we think we're going to get we think we're in a commodity cycle, you know, companies like Finning for Caterpillar equipment are likely to do quite well. But going back to the political instability issue, I would think that would be more likely to impact bond markets than stock markets. But policy changes can have an impact, and if there's enough volatility in policy, then you know people would sense that as a question mark. But right now, market seems to be comfortable despite all the things that are going on. Alejandro is asking a question. Do you know why insurance companies have been experiencing a difficult time in the US? So he's asking about the KIE ETF. And the KIE ETF is made up of insurance stocks. It includes property and casualty companies. It includes insurance, life insurance companies. I think that some of the natural disasters in the US have impacted some of the property and casualty companies. I think there are some who own the property and casualty companies as a way to be defensive in the spring when they wanted to be out of some banks. But that all being said, banks have shown relative strength in the capital markets, banks especially. So it may be that money is flowing from a more defensive asset into a more offensive asset within the financial services sector. It's a great question. It's something that I'm watching, and we'll have to see. Paul is asking, a recent report says Canada may actually be short nat gas as exports ramp up over the next few years. Due to tariffs, some importers, Japan and China, are turning away from US as a source of LNG. Isn't Canadian natural gas companies like ARC could be a better choice than USA? Listen, we think that ARC is going to have a tailwind as liquefied natural gas exports from Canada ramp up, and Tourmaline as well. We think that there could be a secular long-term theme in these companies. And you have to remember that when these moves get going, you can go months where things consolidate and do nothing. You know, here we are in July. It tends to be nat gas companies don't do too much in the summer. But yeah, I think that the whole sector probably has a tailwind going forward. And we own LNG Cheniere, which is liquefied natural gas infrastructure company. We own some ARC, although we've let some go just because in the near term there's other things that are more interesting. Jerry is asking a question. With Trump announcing a 50% tariff on copper, what would the impact, specifically Canadian producers like Capstone and Hudbay, be impacted as opposed to US based ones? So we own Freeport, FCX, and it's copper and gold, US company. It probably has a little bit more help from the tariffs. But in general, I think that this will serve to raise prices, and ultimately most of the copper companies benefit. One more question. Jamie is asking about Bombardier and is there room to go higher? It's a stock that we've looked pretty closely at. The business jet market is just very strong, and Bombardier is a firm player in the space, and the backlog continues to grow. But maybe I'll have Amit or Brian come on and we can talk about Bombardier over the next couple of weeks, because the stock is doing quite well. With that, I think we got everybody. I want to thank everybody for joining today. It's 50 minutes, long time to be patient. We'll be back again next week, and we'll take the developments as they come, and I'll share our thoughts. And if there's something we didn't answer, just don't hesitate to reach out. Certainly always happy to have a conversation. Have a great week, folks.